All right, let's get started. First, I want to welcome everybody. We obviously have a big group this week. I know this is, for a lot of you, it's your Christmas present to yourself or holiday present or whatever, and we're certainly glad to have you. Not typically used to working with so many at once, but we obviously had a big crowd come in at the end of the year, and everybody got a little bit backed up. There just wasn't time to do everything right at the holidays. So welcome, and the first thing that I'll tell you is that this is a really great environment to be in, and you'll get out of this what you put into it. And a lot of people, when they first come into an environment like this, can be a little reserved. You either feel like you know more than other people or know less than other people, and it can cause you to be a little bit reserved and not participate as much. And I would encourage you to get over that as quickly as possible. The best thing that you can do is begin to engage the room immediately. You'll find that there are excellent traders in here that are very well versed in this, and I'm not always going to have the answer for you. That's why this environment is so great, is that you can get feedback from a lot of different people. It really, I think that there's a pretty steep learning curve on order flow because it's something that most people aren't familiar with. But the way that we present the information, by the end of the week, you should really have a very strong foundation to build from, and really understand the key elements of how to read the market. But that's only going to get you so far. Beyond that, it's going to take practice and interpretation and a lot of things like that. This is obviously not something that we're asking you to plug into a piece of software and it's going to tell you when to trade and how much money to take, and at the end of the year you're just going to count profits. There's work involved, and the more that you'll open yourself up to the room, asking questions and kind of establishing a presence here, the easier this will become. I think you'll also find really good friends in here. Trading can be a lonely business, so I think we're very blessed to have brought people from all across the globe together to trade together and really have a good time. When trading is slow, we tend to talk sports, fishing, and politics. You're always welcome to join in or not. And certainly don't let anybody offend you in here. I promise, regardless of how twisted the conversation gets, it's usually kept pretty much under control, and there's certainly nothing derogatory directed at anybody. And so if you feel that you're taking the brunt of something, let us know. The other thing is that in order for this to be a successful relationship, and that's between you and I really need to know how you're doing, and you need to be able to talk to me and let me know what's going on. I can only make some assumptions about what you know or how you're doing, and text chat isn't always the best environment for that. So I try and make myself available to all the students as much as I possibly can, and it's up to you to take advantage of that and make sure that that door is open from both directions, and it's not just me who's sitting here saying, hey, when you want to talk to me. If you've got concerns or things that are bothering you or things that don't make sense, you need to address them with me quickly. That's the only way that we can get on top of things. We can't go for a month and then have you say, well, thanks a lot. All I did was lose money, and I need you to help me fix this. If you're struggling for one day, that's one day too much. You didn't sign up for this to continue struggling as a trader. You signed up for this to open your eyes. And so we don't want to go even an extra day with you frustrated or not being able to follow or anything else. So make sure that you do engage in that process. Throughout the week, we're going to talk about a lot of different things, and it's going to start off a little bit slow maybe for some of you, because we really have to hit the foundation of what order flow is and what we're trying to accomplish before we can get any further. And I'm a big believer that everything comes out on the table this week. There's no secrets. There's no special tricks or anything else. The only way that you can make improvements in your trading is to have a lot of transparency and the ability to follow along and see when something you're doing isn't working and understand why and how to make corrections. And so, as the week progresses, those are the things that you need to think about. Am I really understanding everything that is being told to me, or am I just taking this at face value and saying, well, if DB says that it works, it works? That's not good enough. It's never been good enough for me, and it certainly shouldn't be good enough for you. If you're going to take the time to pay for something and expect to gain knowledge out of it, it needs to be flush with you. And so if you feel that you've got contradictions in things or things that aren't working, address them immediately. Let's get it on the table and see how we can get you through it. What I've found in my life in trading has been very similar to any other life experience. When something is going wrong, it's typically not something that requires a major transition or major correction. My father is a pilot, and when he was flying, when I was younger, one of the things that he taught me about flying and about life is that typically there's only a very small correction needed. If you overcorrect in an airplane, it's going to be a disaster. So trading is very much the same way. And what I find with many traders is that as you approach something, you look at something new, maybe you go to a webinar or a seminar, or you do a trial of an indicator or something like that. You get very excited when you see successes, and you feel that you've found something wonderful, and then the minute that something goes wrong, oh, well, this doesn't work anymore. And you pitch it aside, and then all of a sudden it's, well, I need to look at the things I used to look at, and I need to combine this, I need to do this, and it ends up being this massive transition from the path that you're on. And that's why usually most people end up right back where they started, saying, well, I have some good days, but then I'll have one bad day and it'll wipe me all the way out, or I can't pull the trigger. About that, having a little bit of audio problems this morning. Anyways, the point is that we'll get you where you need to be with a series of small corrections for the things that you're doing. And if you discard everything that you've been working on because of something going wrong, listen, this is just not going to be the industry for you. I've seen it a million times with traders, and they just end up throwing away something that they know and can build on because of something going wrong, and rather than trying to understand what went wrong, it's just a discard of everything that they do. So try and stay focused with this. This is on the surface something that looks very complex, and once you get a layer down, you realize that it's a very simple way of looking at the market. And particularly in the short term, understanding things that most traders have never been able to associate, like actually understanding what risk to reward means, and how to come up with a target, and how to come up with a stop, and how to know whether or not a trade is worth taking based on some goals that you lay out for yourself, rather than a computer just saying, well, this has to be it. So hopefully it will be a great experience for you, and we're certainly looking forward to the whole week. We're going to start off with getting some foundation under our belts. For many of you, this might be a little basic and fundamental. All the same, I like to start at the same place. And tomorrow we'll get into specific patterns in the order flow. Wednesday will be focused on understanding how to actually place a trade. We'll spend the entire day discussing placing a trade, finding the stop, finding a target, what we need to do to get it done. And then Thursday we will shift into looking at chart structure, which is a more macro side of things. So the first 3 days very focused on the micro side of the market. How do we locate what's happening right now? And then Thursday we'll shift over to understanding the bigger picture. And Friday, tying it all together. One thing, because we have so many people here, and this is only if you'd like to, I would very much like it if you would take a few minutes at some point, either tonight or the next day, and just write me a little introduction as to who you are, where you come from in terms of trading, what your expectations are, where you've had trouble in the past. Just a little bit of history would go a long way for me to help you so that I don't find myself talking down to anybody who has a really strong background, or shooting underneath the bar for those of you who don't. So it would be very helpful to me if you do that, and I think it would help us work together in the future. It's a big commitment for both of us, so it helps if we're on the same page. As we get into the basics of order flow analysis, today we're going to talk a lot about how the market actually moves. There are a lot of people who just can't get the pieces together. They think, well, if somebody's buying, then the price goes up, and if somebody's selling, the price goes down. But there's a true process that goes on there with the auction. We'll discuss about things like the fact that the market will very often probe in one direction looking for price boundaries and then rotate back off of that, and how we can make use of that information. We'll need to get a basis for how we classify volume and then how we plot that volume. We have a neat little chart and everything, but if you don't understand where the data comes from, it won't help a whole lot. Then we're going to talk about how volume actually enters the market. One of the key things that we're always looking for is where the largest cluster of volume takes place. That tells us quite a lot about whether or not we have buyers accumulating or sellers distributing. And if we can get ourselves positioned with those that are profitable, that certainly makes a big difference rather than constantly fighting, for example, this morning. And we'll discuss how we can determine the directional control from those clusters. The first thing that we need to get through is a basic understanding of the market auction process. This is kind of an expanded illustration of what you might see on your dome or market depth. I realize not everybody here uses NinjaTrader, but pretty much every trading platform out there now has a market depth or price ladder where you can see the supply and demand that's in the market. And what those represent are essentially resting limit orders. So if we have supply, we have resting orders that are waiting to sell or that have the intent to sell into the market. And if we have demand down below us, we have resting limit buy orders that are waiting to be filled. And the process of those orders being filled depends entirely on whether or not there are willing participants for the other side. So what most people fail to recognize as novice traders is that there are always two prices in the market. That's what an auction means. We always have to have a bid and an ask price, and so very often people are used to looking at a chart and just simply saying, well, the price is $23.50, when in fact the bid price may be $23.50, but the ask price may be $23.75. And so if we understand how that relationship of supply and demand interacts with people's willingness to accept or decline those prices, then we can understand what it takes to physically move the market. I very often had novice traders in a guest environment say, hey, how much trade does it take to move the market one tick? If I put on 1,000 lots, would it move the market up? And the response is that, of course, it completely depends on how much supply there is. In the case that we're looking at, if we have resting supply of 200 contracts at $23.75, that means that we have essentially 200 contracts that are trying to go short, and they want that price $23.75. So we have to have a willing buyer buy into that. Okay, so if we consider that for a minute, well, we know exactly, and granted, these are static numbers, and obviously your dome is never going to be static. But it doesn't change that drastically. We always have an idea of what it actually takes to move the market. In this case, if we were to have 201 buyers come into the market at market, then they would in fact absorb the 200 contracts at $23.75 and essentially move into the next price level, taking out the 200 at $23.75 and one from the 400 above at $24. that would in effect move the market up. Okay, so what it takes to move the market is always more or less right in front of you. And when we see the market move very quickly through the market depth, we have an indication that trade is one-sided, or that buyers are only buying as opposed to sellers then reloading those price levels and trying to hold them at various levels. So if we understand that process, we could say, well, what would it take to move the market all the way up through the market depth? How much trade would have to come on essentially for us to see the market? If nobody else added any contracts to this, how much trade would it take to move the market up all the way through the market depth? And what we would essentially come up with is we'd need to take out the 200, and we'd need to take out all of the price level, all of the levels in between, to get us to a point where we start moving the price up to 24.75. So essentially what we would need to come up with in this case is about 1,501 buyers. That would move us all the way through the market depth and up to 24.75. Okay, obviously the same would be true if we were selling through. If we wanted to see the price move from 23.50 down to 23.25, we'd have to have more than 100 contracts come in at that price. And if we saw 101 contracts hit the bid, then logically the bid price would then move down to 400 and we'd start absorbing those. So that's really the market auction process, and it's important that you understand that, because as we get into making assumptions about whether or not there's light volume or heavy volume, the biggest mistake that most novice traders in order flow come up with is they come up with static numbers in their head. They say things like, well, boy, that's a whole lot of trade there. This morning we had a whole lot of trade right at the open, if all you're doing is looking at the bid and the ask. But in fact, when we had 2,000 to 3,000 contracts at every price level, seeing 2,000 or 3,000 contracts get print at the bid or at the ask isn't very much. So it wasn't very substantial. So it's all going to be relative. Now, as we see the market move, what we have to understand is that we've got a relationship there where we have, in the case of the market moving up higher, if we have buyers buying through the market depth, then they're going to probe through and buy until they reach some point where there is what we would call resistance or added supply into the market. So if we trade all the way up through the market depth, 200 contracts and 400 and 600, until we start to see more sellers adding on and not allowing the buyer to continue pushing higher, then we will be in a directional probe to that point. And once we reach that point where the market begins to balance out, we will have seen that, in fact, maybe price is a little bit too expensive for buyers to continue wildly buying. And it works obviously in both directions. So while most people would look at a chart and say, well, over the course of the day or whatever, boy, the market really moved up and then it came down, what we may actually see is something where we've got the price too cheap and then too expensive and too cheap and too expensive and too cheap again and too expensive, to where we're constantly in a state of probing higher and lower, back and forth, as we search for what fair market value is. So on a day where we may move up several points and then back down, it may end up that we actually look at the market as having several auctions throughout that process, and that's essentially what our chart is going to show us, are the directional moves where we're just looking at one side of who's in control for that moment in time and where they find it to be either too expensive to continue buying or too cheap to continue selling. Now, as we start to look at the volume that's engaged in the market, there's some very common things that we can see throughout just about any major movement. When we see that buyers or sellers are having an easy time pushing through that market depth to get somewhere, we will usually see very light trade. Now again, light is only relative to how much market depth there is. So for example, if we were to see currently above us anywhere from 1,500 to 2,000 contracts at any given price. If we were to move up through the next series of prices and see that we traded at the ask price anywhere from 1,500 to 2,200 contracts, we would say that's fairly light, in the sense that they were able to just move right through any sort of supply that was in the market. So when we see light trade in an upward fashion, we would say that demand has pushed through the supply. In other words, nobody is adding to the supply to hold back the buyer. As we reach a point where we'll start to see the market slow down and perhaps even reverse, that's when we see that supply start to come in and meet the demand. In other words, if we've got this great demand pushing through the supply, the only way we're going to stop the market from moving up is to have somebody else come in and replenish the market depth. So if we were to move up to 2850 and trade the 2,000 contracts that are currently there, if nobody else comes in to sell at 2850, then we're going to continue up through the next level. But if we have more supply come in, we'll start to see much heavier trade, and that's typically what we'll see at highs and at lows. Feel free to post questions, but most of the time I'm going to wait till the end, okay? Because typically your questions will be answered along the way. So if you want to post questions, or if you just want to write some down, we can obviously come back to any point here. So what we're looking for is when we see that heavy trade begin to hold up an upward movement. If we then see the market rotate and start to trade down in a light fashion, where we're literally just cutting through all of the demand that exists in the market, we'll usually see light trade, and that would be indicative of a directional move. Okay, so a lot of people get confused by seeing a lot of buyers or seeing a lot of sellers. Well, it's only going to be beneficial in terms of a directional move if they're profitable. Okay, and we'll explain that a little bit further in a minute. So eventually, if we have light trade moving down where we have supply outweighing demand, then we would have a point where the demand would have to come in and meet the supply in order to stop it. So if supply is simply selling right through all the existing demand, we would have to see an increase in demand in order to stop the market from declining. And then again, we would probably see light trade if the market were to reverse from that. Now, if we take a look at our market depth, or whatever trading platform you're looking at, we can typically see the two prices that are current. In the ES, they're very rarely ever more than a tick apart. Occasionally they do get a little bit of a spread. But for the most part, because it's an electronic contract and very heavily traded, they're only going to be a tick apart. And what that allows us to do is note where the supply and the demand are, obviously, and then also we can see where the last trade volume took place. In this case, we had one contract trade at 10.20.75. Well, if we look at the relationship there, we can see that that one contract was in fact traded while 10.20.75 was the bid price. Okay? And that'll tell us an awful lot about how that volume was executed into the market. As we said a minute ago when we were talking about the auction process, if we had the 200 contracts that were resting ready to go short, the only way that they're going to get filled is if someone's willing to buy those. So we have to have the other side of the equation there. And so it's important for us to know exactly where that trade took place, not just in price, but whether it's the bid price or the ask price. So if we blow this up a little bit and look at it, we can see in this case we have 43 contracts waiting to go short at 21 and 70 waiting to go long at 20.75. So if we have 70 contracts here, obviously they're going to require sellers willing to pay that price, willing to offer at that price. Okay? It's the only way that they're going to get filled. And obviously at 10.21, okay, is anybody else having bad audio? I hate to switch to a headset, but I can. Okay, great. Very good. All right. So the point is that obviously we've got to have somebody taking the other side of that trade, and so it really comes down to who's willing to pay more or who's willing to sell for less. Our biggest concern here is the concession. Okay? In this example, if you're looking to buy a car and you're the buyer and the seller is the dealer and the car represents the trade, if the dealer's asking $70,000 for the car but you're only willing to pay $60,000, then it's very much like a trading example where you've got a limit order on and the market's trading a little bit above your price, right? So it really comes down to whether or not you're willing to get excited and concede to the asking price, or whether or not that asking price is going to come down and allow you to buy it for what you want. If we look at the example where the dealer holds firm and says the only way that I'm selling this car is for $70,000, then if you really want that car, you're going to have to concede to that price, right? It's the only way that this trade's going to get done. So if the trade takes place at $70,000, in other words, if you buy that car for $70,000, then you as the buyer have lifted to the seller's offer. Okay? You've initiated that trade. You're the one who stepped forward and said, yeah, I just want it. Okay? You've made the concession. Now, the other side of that is that if you hold firm and that dealer really wants to sell his car, well, he's going to have to sell it at your price. Right? Well, in that case, he's got to hit your bid. Okay? He's got to initiate the trade. You're the one standing firm. You're the one not budging on your price. So it's a very simple process of limit orders versus market orders. Who's willing to accept the concession? And whoever that is initiating the trade. Okay? So if we have a seller hit the bid, then the trade is initiated by a seller, and if we have a buyer lift to the offer, then we have a trade initiated by a buyer. Okay? So in our example here, if we understand the intent that comes along with what takes place, if we have a portion of buyers go ahead and say, yes, I'll take that 1021 instead of the 1020.75, then they're making that concession. They are the ones conceding to the ask. And so that trade would be initiated by a buyer. Conversely, if we've got sellers and they're willing to concede to the bid price of $20.75, then we would see that trade at the bid initiated by sellers. Okay? So whoever concedes is obviously the one who's initiating the trade. Now we're interested in that because that's how, based on the first slide we looked at, that's how the market price moves. We have to be able to understand the auction process and realize that by having people concede, we're going to either move the price up or we're going to move the price down, because there's always going to be a limited amount of market depth. So if we take that information, we can then plot it on a chart and begin to make some sense out of things. We can tell whether we have light trade or heavy trade. We can tell what the amount of trade executed at a price is in relationship to the market depth. We can tell whether it was initiated by a buyer or by a seller, and whether or not there's considerably more trade than the market depth, and yet they're not able to get the market to move anywhere. So it's a great process for us if we know how to organize the data the right way. So in this case, we have one contract that traded at 10.15.25, and obviously 10.15.25 was the bid price. So we have this plot on the left side of the chart. We have one contract initiated by a seller at 15.25. Now if we look at it after this trade, on the previous one we have the 11 contracts up at 15.50 at the ask. More come in at 15.50, while 15.50 is the ask price. So we have one contract traded at the ask. So the 11 now becomes a 12. And that's how we plot volume at price. On the downtick, we have 5 contracts that are traded at the bid. That means that we have 5 contracts initiated by a seller at 15.25. Now, like anything, it's going to take a little while for you to get familiar with the way that we chart. But for the most part, it's very similar to anything else you would look at, whether it's a candle or a bar chart. We have an open, a high, a low, and a close. But what we're going to do is plot the volume inside of that. Okay, so if we have longs that are trading into offers, or if we have trade at the ask price, it'll be in green on the right side. And if we have shorts that are trading into bidders, or volume that takes place at the bid price, it'll be plotted on the left side. We also have a purple or blue designation on our chart, and that represents the highest volume within the period. Now that's going to be important here in just a minute. That's the collective volume, both executed at the bid and at the ask. Okay, it's just a way for us to train our eyes to a point on the chart so we can see where the majority of trade has taken place. The other thing that our chart offers is what we call the commitment of traders, okay, or the net volume that we see, meaning all of the buyers less all of the sellers, giving us a net total. In this case, if we had 100 buyers and 200 sellers, we'd have a net of negative 100. So all negative, trade initiated by sellers being counted as negative numbers. And from our transition points, as we begin to rotate from a probe, we'll have an idea of how many traders are committed into that rotation. Now, the reason that we're so interested in plotting all of this is because if we do it the right way, and we can see essentially the volume that's taken place in any directional probe, then it's very easy for us to understand where the majority of trade took place. And by gathering where the majority of trade has taken place in any given auction, we can tell whether or not somebody is profitable or if somebody is upside down. And that's going to play a big factor into how we look at opportunities in the market and really isolating our edge. So from this point forward, you're going to hear a lot of discussion about volume clusters. Okay? And so it's important that you understand what that means. What we're looking for are 3 to 4 consecutive price levels that contain the highest concentration of a period's volume. Okay? And I would go a little further and tell you to make a note that it's the period references the directional probe. Okay, so what we're looking for is the highest concentration of volume in a directional move. Right? Obviously, if in the first one we have a tremendous amount of trade that's taken place at the top, okay, at the high of this move, if the buyers were able to continue and push this further up, then we would say that the highest concentration of buyers are profitable. However, right now, the highest concentration of buyers are not profitable, are they? In fact, the highest concentration of sellers are the ones that are profitable. So it makes sense that we would want to know that. I'm much more concerned about the 3,500 buyers at the top of this than I am the 175 buyers down at the bottom of it. I mean, great, 175 of them are profitable, but look at all the guys that are now up here trapped, that executed much later than where the light volume, easy move through market depth took place. They're in a much more precarious situation than the people down below, and that's where the majority of them are. So in the second example, we can see 3 price levels essentially right in the middle where the bulk of trade took place. Up above that, it's fairly light, indicating that the sellers didn't really have any trouble driving through the market depth. It was probably extremely light. And then as we trade down into the middle, we can see that volume increased substantially. And then as we trade down further than that, we see a tremendous amount of selling again take place. Okay? who's in a better position here? The seller, that the 1979 and 1396 sellers that came in, or the 2300 and 2200 that came in the middle? Right? Obviously, the profitable sellers are already in the market, and those who joined the party late are now in a state of not knowing whether or not their trade is really working out. So it's important for us to always be able to identify where the majority of trade took place and whether or not those traders are profitable or upside down. Obviously, the buyers in the middle of that have been upside down for almost 2 points, and they're starting to draw back into where they executed. On the third example, again, we've got fairly light trade in the upper portion and the majority of heavy trade down below. Now you can notice that not all of these are exactly just the little purple line. What we're looking for are 3 or 4 consecutive levels so that we can get a sense that there's really a lot of trade that took place, not just one price level that happens to have 2,000 contracts that executed there. And we want to know that there's really a condensed group of traders that executed trade. Now, as we begin to learn what these clusters mean and how the market reacts to them, we'll start to see things like being able to indicate overall directional control. Now, if you remember, we did a chart earlier talking about, I guess I'm not quite there yet. Essentially, what we'll see are different patterns that we can begin to derive trading decisions from. In this case, the first period is heavily weighted on the bottom, okay, indicating that sellers were trying to push the market lower, but buyers managed to get on top of those late sellers. Okay, that indicates that there was a responsive buying effort. Okay? And then as we trade up through this, the next period, we see a period where there's a tremendous amount of volume in the middle of the period. Okay? And other than that, it's extremely light. Okay? Very light trade, and we can see that the buyers were victorious, for lack of a better word, of pushing the market higher, indicating that they were able to initiate enough trade to move the market higher. As we move up to a point where the buyers then have much more trouble and they meet the supply at the top, it doesn't take very much for a seller to come in and bring the price down enough to put those guys in jeopardy. That's what we call responsive selling. Then as the market rotates down, you can see the pattern there of light trade. We discussed light trade versus heavy trade earlier. As we see the light trade come down, we see the majority of trade basically centralized, and the sellers able to initiate enough trade to get through those levels and push the market lower. Then in the next one, we see the responsive buying pattern again. Okay? And as we move up, buyers initiating trade, and eventually up to another example. Okay, so earlier we were looking at a slide, this one, where we said we would see primarily light trade when we see demand pushing through supply, and then starting to see heavy trade again. Okay, this is where we would be looking for a volume cluster much heavier, and then light trade trading through, sellers initiating trade, and then heavy trade again, and then light trade off of the rotation. Okay, well, that's exactly what those patterns correlate with. When we see buyers initiating trade and we see centrally located heavy volume where the buyers have gotten on top of it, then we expect to see light trade push up to the next place where there's a high concentration of trade. And if that takes place at a high, where buyers are no longer able to continue pushing, but instead get trapped upside down, we would see a responsive selling effort, and so on and so forth through the pattern. So from that information, we could say that cluster placement, or the price levels of the volume cluster in relationship to current price, or prices, would indicate directional control. Okay? In the first example, we have what we would consider to be buyer control. The reason is because we have the buyers lift the price, and run into a level where obviously it took them a little bit of effort to get through, because just look at the right side here. If we've got 445 and 1,046 and then 2,400 buyers coming in, suddenly they have to print 4,000 to get the market to go any higher. Okay? Well, we don't ever see 4,000 contracts in the market depth. So obviously what was happening is every time the buyers would try and buy through this price level, more sellers would come on and say, here, you want to keep buying it? You're going to have to buy mine. Right? An increase in supply. Well, in this case, eventually those buyers are able to buy through that. So we would say that they've initiated enough trade to get on top of the one place where they were having trouble. And by the fact that we're trading on top of that, we can say that those buyers are now profitable. The highest concentration of trade is buyers that are profitable. And we have the highest concentration of sellers that are not profitable. Right? So that would indicate directional control moving up. In this case, we have sellers moving down with fairly light volume, indicating not much effort to get through the market depth. But we suddenly reach a point where it goes from a few hundred contracts moving the market to 2,000. Obviously, there's an increase in demand here, where the responsive buyer is saying, no, I'm sorry, you're not going to get through it that easy. Okay? But if the sellers are able to sell enough to break down beyond that level, then we can obviously see who's in control, not just from the fact that price moved down, but because we have the majority of trade dominated by sellers who are now profitable, as opposed to the buyers who are now, where the majority of buying took place, is not profitable. The reason this is important, guys, is because in everything that we do, we have to have some way of valuing the market. And much like a stock speculator will value a stock of a company, comparing things and saying, here's how much cash they have on hand, and here's what they're trading per share, and outstanding shares and everything else, and the ability to physically come up with a price where they'd be interested in buying. And our market is no different. There's a valuation that somebody has to come up with to say, yes, I'm willing to put several $1 million into the market. Okay? And for most people, you're just following and chasing indicators and saying, yeah, okay, well, the market's moving up and the market's moving down. But what you have to remember is that we trade against people who value this thing every day. Okay? And in this particular case, if we were able to buy through a level like this, then we had buyers who valued the market too cheap at this level. In other words, it wasn't too expensive. They were happy to continue to buy. Well, that's important for our future. Okay? Whether that happens immediately or whether that happens much later. It's important to know that the majority of buyers came into the market here. This is where they valued the market as being too cheap, and thus probably will do the same thing the next time around. Okay? If you value a company at $56 a share and it goes up to $62 a share, you can be one of two people. You can be the person who says, well, I know what it's worth and I'm not going to pay too much for it. Or you can be the person that says, I'm going to miss it, I'm going to miss it, and get in, right? And pay too much for it. Well, smart traders don't pay too much and they don't sell too cheap. So by looking at where a cluster is in a given probe, you can very quickly value the market and say, listen, this is where somebody with a lot more money than me and a lot more smarts than me said, this is the value of the market at this point in time. Now we've got several, I say several, we've really only got a few patterns that we look at, which tell us an awful lot about what to expect out of the market. And we would break those into patterns that indicate directional control, or what we would look for breakouts or breakdowns. And then we also have patterns that would indicate control shifting, or what some people would call counter trend or counter probe, or against the momentum. And so when we look at patterns like this, we can see Things like, in this case, the buyers driving the market price up. In other words, more or less just moving right through the market depth, reaching a point where it was a little more difficult for them to get through, potentially looking for opportunities to sell there maybe, but eventually the buyers managed to get on top of that and drive the market higher. Well, when we see that happen and we've got a strong enough risk to reward, we can look at that as a buying opportunity. And so instead of buying the high as we break out with a buy stop and saying, gosh, I just hope I didn't buy the high of the day, what we're looking for is the market to move back into where the valuation level was and be able to take advantage of that pullback to get a much better position that we can, and we won't always get filled, but what we can do is we can look at it and say, look, I can justify the risk now because I know where it's likely to come down to. Imagine for a minute that you buy as this thing starts breaking out and you're part of the 772 that buy up at the top of the first period. Well, we know where the valuation was. It was back down where the 3,700 and 2,500 came in, but you chose to buy all the way up there. Now what you've told yourself is that I have to be willing to take that much of a drawdown or I have no business being in this trade. Okay? And so in this case it does work right back to where the valuation level was or the high volume. And then we see the market expand again and continue up further with another period of buyers initiating trade. So that's essentially what we look for in breakouts. In breakdowns, in this case, we have light volume trading down to a point where volume starts to increase. The sellers are able to drive through that, and as the market pulls back into that valuation level, we have an opportunity to hopefully sell it down, and in this case down to a point where it starts to look like there might be an increase of late sellers that are in a little bit more of a predicament. So those are the type of patterns that we'll look for when we're looking for breakouts or breakdowns. When we look for a potential change in control or something that is more against the overall momentum, we're looking for the exact opposite of that. We want to see that original directional control come in, but then find that really the bulk of trade takes place up at the top. Okay? This isn't the 500 or 498 down from the bottom. We start trading a lot more up at the top, and these late buyers put themselves into jeopardy. And as we see sellers begin to come into that, we can take advantage of it if it coincides with other things that we're looking at. So that's an example of what we would consider a resistance pattern, or what we call responsive selling. In this case, we've got a situation where we have a probe lower, obviously sellers being in control. You can see pretty much every price level there's more towards the upper portion, there's more selling going on than there is buying, selling right through the market depth. And as we reach a low, we somehow draw in a bunch of sellers, right? They weren't interested in participating earlier, but now they want it late. Well, anytime you come in late, you've got a tremendous amount of added risk, and it doesn't take very much for you to get upside down. In this case, by just lifting it up a little bit more, those 1,500, and count the 4 or 5 price levels down there at the bottom, you've got about, 20, 30, 4,500 contracts, give or take, down there that have all executed short. Now, they didn't get in with the 633 or the 302 up at the top. They chose to get in much later, and that puts them in a situation where the majority of them could very easily be upside down. Okay, so instead of being able to sell through and have sellers initiating trade, in this case we see a responsive buying effort. So those are really the 4 patterns that we're going to be looking for, and obviously they get a little bit more complex as you add other components to it. But in short, that's all that you really need to learn about order flow, is understanding where the majority of trade took place and then determining whether somebody is profitable or not. And personally, I want to be positioned with those that are profitable, and if I find myself suddenly positioned with those that are unprofitable, I better have a way out. This morning is a good example of that. You have to constantly be looking at it, not as just a method of entry, but saying, okay, well, what opportunity does this provide me? And if this condition changes, I may be seeing an opportunity to go short, but if this condition changes and this pattern no longer exists, I best be ready to react. And learning how to react is learning how to manage a trade. In this case, you can see what's taken place after both of those patterns. The first one, we moved up into heavy trade. Once we get too much trade up at the top, it's kind of like anything else that's top heavy, very easy to roll it over. And we go from a period dominated by buyers to one where we see the responsive seller come in and then sellers initiating trade in the next period. The second grouping is sellers being in control and finding that too many sellers came in late. Very easy to get them upside down and roll it over. And then we see buyers initiating trade afterwards, reversing the market. Okay, so I know that doesn't seem like a whole lot to start with, or maybe to some of you it does. It's very important that we get off to the right foot. And so the first day, I'm really mostly interested in making sure where data comes from. Because if you don't have a foundation for understanding why we say that something is initiated by a seller, or why we say something is initiated by a buyer, or why we're interested in where the cluster of volume is, then the rest of this is going to be very difficult. So tomorrow what we'll do is we'll start getting into trade patterns, and we'll go through an awful lot of them. And what we'll do is start to get you to a point where you can recognize this all throughout the day. I want you constantly, with the exception maybe of today's lack of activity from 9:30 on, I want you constantly all day long classifying what you see. Where is the control? Okay, buyers are in control. All right, buyers have initiated trade. Well, what happens when they can't buy anymore? Now that has changed, and I see responsive selling. And that's going to be the process for the next couple of days, is being able to take what you see on the screen and classify it. Be able to put it into one of four categories. And if it doesn't fit into one of those four, then it's garbage. And it's telling you that you don't need to participate. And I'm going to tell you guys, knowing when to not be in the market is more important than finding the best entry in the world or learning how to manage. If you can understand when you need to stay away, you'll do much better. That's the bottom line. There's times of the day when there's great opportunity, and there's times of the day when there's nothing but people losing money. And particularly on the retail side. So don't make yourself one of those. If you've got questions about anything that I didn't address, by all means, feel free to post. And otherwise, we'll continue tomorrow with trading patterns.